Good morning and welcome to the Joseph Apartments Talk Show. Today I have a special guest that's going to solve the problem of I've had an apartment building for 25 years. I paid $100,000 for it. Now it's worth $2 million. I want to sell it, but I don't want to pay capital gains taxes, and I don't want to buy another apartment building. So I brought in Jesse Cox from Coastal Wealth Management. Thanks for coming, Jesse.
Yeah, no problem. Happy to be here.
Jesse is going to help me plow through this list of what's now 16 different options. So if you're an apartment owner and you want to sell, don't just think of yourself as having only 2 options or 3 options. There's actually at least 16 different options. And I brought in Jesse because although he may not do all 16 of these, he is an expert in this field. And Jesse is going to guide you through what would work best for you. So I just want you to open your mind and think of more creative ways that you can dispose of your asset, avoiding capital gains taxes, and living the lifestyle you want to lead. So Jesse, give us a little introduction on yourself.
Yeah, thanks, Jim. Happy to be here. I am a financial advisor, been registered in the securities business for roughly 25, 26 years. In interest of full disclosure, I'm registered with Independent Financial Group out of San Diego, and they're a broker-dealer. And so from a compliance perspective, just in interest of full disclosure there, a lot of the security-related investments that we use in the tax planning business require securities registrations. So just wanted everyone to know that. My background is been doing this for 25 years, cut my teeth in the early broker-dealer days, insurance and estate planning and tax planning, investment business management, RIA type business. Just built my firm up over the years, and predominantly in the securities business, you're managing wealth, and a lot of that requires, to your point, tax savings. And so when it comes to highly appreciated real estate and stuff like that, to your point, there's a lot of opportunities out there. It's very interesting how people don't know a lot, and what you don't know in life sometimes can't hurt you, but in finances, what you don't know can hurt you. And so making the wrong decision on selling this and just paying the capital gains or reinvesting in something that you aren't really aware of, you don't know the risks, based on the risk and return. So happy to be here and discuss these things with you.
Now, obviously, I want to make it very clear. I'm just a realtor. And all I'm saying is that there's options that are here, and I would strongly advise you take this list. I'll have them put that on the screen, and take it to your financial advisor, your CPA, and have them explain these to you. Or you can just Google these items. Most of these items are well known, been around for a long time, but I'm not an expert in this, and I would strongly encourage you to do that. Now, most CPAs are very conservative by nature, and so they don't like to be out of the box. So you may have to tug them along, but obviously your CPA, your financial advisor, your tax preparer should be aware of these options. And if not, you want to have them maybe research it and see if it's right for you. But with that caveat, let's just dive into the list, Jesse. The first one is a real estate investment trust. So the premise that I'm going to have this conversation is I've got a 20-unit building in Buena Park. Mm-hmm. We're in escrow. And then I'm going to tell my clients, okay, you don't have just the option of selling and paying capital gains tax. You don't have just the option of selling in Buena Park and buying a Fullerton a property bigger. You can take that money and move it into a real estate investment trust. What's a REIT?
So a REIT is a collection of investors that come together, kind of like a mutual fund environment where they actually buy the real estate and invest in the property. It could be apartments, it could be self-storage, it could be hotels, you name it. Commercial, industrial. And so that's a group of investors that, let's say if we added our money together, we probably wouldn't be able to take down a several $100 million complex. But by coming together as other investors, you buy into and shares of that real estate investment trust. And so oftentimes it provides the access to the real estate that you really want, but without having to do the management. And so I call it mailbox money.
Okay, so I'm making $10,000 net a month. Mm-hmm. And then our goal would be to try to duplicate as much as possible that, but not owning the property. Right. Mailbox management, you sit back and get a check in the mail every month or wired into your account, and then some other professional handles it.
That's right.
Now, I would imagine in your position, Jesse, you could recommend then to my clients a good REIT company that has a good reputation.
Absolutely.
Not going to walk off with the money in the middle of the night.
Correct.
Has a track record and that kind of thing. And that's why I think you're unique in this situation, because you see a lot of money moving around.
Yeah.
and you know who is qualified, who is reputable,
Yep.
who they can trust,
Yeah.
and that's a big deal.
Well, I think to your point, we've talked about this before. I've had several clients over the years, highly appreciated real estate. Let's say there's a 10-plex in Long Beach that's worth, $5 million, but they've exhausted the depreciation. They're scared that an 80-year-old building and the plumbing that goes with that is going to fail. They don't necessarily have the liquidity and the cash to make those repairs happen. The fear is I'm going to lose my income, and I've exhausted my tax benefits. But if I sell this property that I bought for, let's say, $500,000 and it's worth $5 million, I've got all this exposure to that capital gain while losing my cash flow. So what we design and do a lot of work up front with our company is making sure that people understand the ramifications of just an outright sale. Because really, in light of estate planning, capital gains are avoided upon passing. So when you die with highly appreciated real estate, there's a step up in cost basis that happens. And so ultimately, if you can continue a property with income and the maintenance is good, you got good tenants, that's great. You pass away with it. Now your heirs or your spouse receive that capital gains step up, and really they can sell it with zero capital gains. So a lot of times the work up front, and this is no dig on not selling real estate, because I think it's wise to sell real estate once in a while because of the risks involved in keeping it. As people age, they don't want to be involved in managing it. But the reality is there's a lot to be said for the step up in cost basis. So I spend a lot of time up front with my clients, people that you've referred me to, people that I come in contact with, just making sure up front that it's a suitable transaction. And when you start weaving through that, it starts to demonstrate, okay, here are the reasons why we do that.
And you're required by law to do an analysis of
That's
the
right.
person's financial situation,
Correct.
so you don't put them into something that's irresponsible.
That's right.
So a lot of responsibility, a lot of legal responsibility
Correct.
you have.
Yeah, and there's a lot of illiquidity in our business, which scares people into being locked up. The old tenant in common days. But one of the items on the list is called a DST. It's a Delaware statutory trust. So this is where, kind of similar to a REIT sponsor, where they have kind of a fund, they actually go out and buy the property. So they'll go out and buy, let's say, a $250 million apartment complex, Class A, and otherwise, let's say you're selling a $5 million, 5-plex and it's 4-plex or whatever in Long Beach. You want to reinvest that money via the 1031 exchange. You can do that. The DST sponsor company actually goes and buys the property up front. There's usually non-recourse loans in the 50% kind of loan to value range, sometimes as low as zero. And for those of you who don't know, when you sell a property and you 1031 exchange it, you've got to match up the debt and the equity components. Otherwise, there's something called boot, which creates some capital gains. So this process of using DSTs actually eliminates a lot of that confusion, and we can apply a certain amount of debt to that transaction. And so a lot of CPAs love this idea, because now their clients are not paying a huge capital gain, and we've allowed them to get into a better investment in a lot of cases than they were used to, while duplicating that same cash flow or increasing it potentially. You reset the depreciation as well. So a lot of this is really tax advantageous in investing as far as the income
They
coming
can customize it for each client's personal needs then.
Correct.
'Cause they have that freedom.
That's right. And you can split it up. I mean, let's say you sold a $10 million building. What if you wanted to take $1 million of that, pay the taxes on it, have the liquidity, put some money in the bank, give it to the kids, whatever you want to do, and then reinvest the rest of it? A lot of the process and the timeline for 1031 exchanges has a lot to do with identifying and closing. And it's very scary if you're going to sell a property saying, oh, I got to go identify. There's a few different rules on how to identify and when. This takes all the guesswork out of it. I mean, literally, you can go into a really high quality portfolio, duplicating that cash flow, and really kind of take the hands off and not have to do the management.
A lot of my clients really like the DSTs. Yeah. They'll be particularly fond of Tennessee or Arizona or like a red state.
Yep.
And put the money there, getting money out of
Nashville,
California.
Austin. Yeah.
Now the third one on the list is seller carryback. That's typically where you own a property, particularly free and clear, and then you become the bank.
Sure.
So you say, okay, you can buy my property from me, but I'm going to keep the title, and you pay me back every month.
Yep.
Now, the benefit of that is then you can defer the taxes, right? You only pay taxes so I own a 20-unit building in Buena Park. It's worth $1 million. Yep. I sell it to someone, they 20% down payment.
Yep.
I take the 20%, and then I loan them $800,000, and then I only have to pay the taxes. It's a 30-year loan.
Yep.
Every year, so I can defer that 30 years, right? That's the main benefit there.
So similar to like a qualified, I mean, we're going to get there, but the qualified personal residence trust, passing on a primary residence or even a second home, a lot of that is geared toward estate planning as well as the capital gains savings. As you take the income from it, then you pay taxes along the way. So really, it's a question of liquidity, income needs. It might be advisable for someone to never sell a property that they can maintain that because they have plenty of liquidity. It's a building that's been maintained and it's paying good cash flow and they have plenty of depreciation left. On the other hand, that analysis we're talking about up front says, hey, it makes total sense. You're in failing health. You're getting older. You don't want to knock on the door and collect the rents. You're tired of, being a landlord, depending on the area that it's in, depending on the involvement from your family. And if your kids want to start to take over and stuff like that. So, just a lot of analysis up front. But yeah, to your point, the qualified personal residence trust kind of ties in with the seller carryback.
All right, next one on the list of 16 is a charitable remainder trust. I remember years ago, Biola University had a program. Come in, give us your property, give it to us. You'll quote unquote donate it to us, and then we'll give you a return. Is that generally how? So your church, your university, you just give the property to them.
Yep.
It's kind of scary. You give the property to them, and then you trust them to give you a return.
Yeah, and this is more of the higher level estate planning too as well. You have a net worth that's significant enough to where you can participate in doing that. A lot of times it's to avoid the estate taxes along the way. But yeah, if you're charitable in mind, that could be a definite strategy. But again, with all of these, like we've talked, Jim, if you have questions specifically as you're watching this, reach out directly. Sometimes 15 of these might not be applicable, but the one is. But understanding that there's these opportunities out there, I think, is wise. Equip yourself as an investor, as a property owner. A lot of my clients that have highly appreciated real estate, it wasn't necessarily intentional. It was kind of an accident, right? I inherited it from my parents, or I just bought this fourplex because it was, affordable and I lived in one of the units, and so here goes the next 20, 30 years and they've got a highly appreciated asset and they don't know what to do with it. So
the good news is as you speak, your QR code, your phone number and email are right on the bottom.
Yes.
So someone can call you with questions. You don't mind, right?
No, I don't mind.
You don't mind if someone calls you and says, hey, I had 16 items here. Explain them all to me again, Jesse.
Just say, Jim told me to call you.
All right, next one is a 1031 tax-deferred exchange into a multifamily apartment. Now, that's the one that everyone knows about. Yeah. You take your 20-unit building in Buena Park that you paid $100,000 for. It's now worth $1 million. You have $900,000 in capital gains. Yep. You then buy a $2 million property in Fullerton.
Yeah.
And you do that, you pay no capital gains taxes to Uncle Sam.
That's right.
So everyone knows about that one.
Yeah, the tricky part about that one, and I reference this, is really going out and identifying a new property or properties is difficult. And it's time consuming, and the time constraints about identifying and closing are really difficult.
Are you trying to do my job, Jesse? That's my territory.
I think I can.
Stay in your lane. Yeah. Stay in your lane. No, you're right. It's a big deal. You have to get your property in escrow. You have 45 days to identify, 6 months to close.
That's right.
But that clock ticks fast.
It does.
And you're better off, in my opinion, of identifying the up leg first.
Yep.
Then selling yours, and then tell everybody, sit and wait until we figure this out. Because without that disclosure or that exemption, you got a problem. All right, federal opportunity zones. That's where we first connected.
Yep.
Federal opportunity zones. Tell us what that is.
So these are programs designed to really gentrify tougher areas where they want to really create a lot of value and growth. And so the government has allowed you to invest in those properties, sell your property, reinvest into the opportunity zones. Some of them are known as rural opportunity zones, agriculture exemptions for property tax avoidance. We'll probably get to that. But a lot of the opportunity zones are inner city. They're trying to make the area better. And so you can actually sell your property, reinvest into the opportunity zone, and defer that gain for a 5 to 10 year period. At the end of 10 years, all the appreciation on the investment itself becomes tax-free. And it's the income and the growth along the way. If you eventually do have to pay the taxes, the growth of the property and the motivation behind investing in the opportunity zone is that property grows in value. And usually the programs reinvest, they renegotiate the mortgage and they give cash out to pay the tax bill at the 5-year point. But just they're unique. They're definitely an interesting part of the market.
So I sell my 20-unit building in Buena Park, and then we do a 1031 exchange into a area where bullets are flying.
Correct.
and people have shopping carts.
Yeah.
You know, they're living in shopping carts. But you hooked me up with a company.
Yeah.
I forget who it was.
Griffin,
It was a very well-known company, and they then go in there and they build these very nice housing units in those areas, and they manage that.
Yes.
And it's very profitable, and they figure out the security, they figure out safety, that whole thing.
That's right.
And you're actually doing good. You're helping the city, the county.
And I've had several clients over the years, let's say they're selling that $1 million property, or maybe not all of it goes into one particular product. I mean, we have a lot of fluidity and a lot of option and choice. If we wanted to put 20% in an opportunity zone, 20% in a DST, take 20% in cash and pay the taxes. I mean, there's a lot of flexibility.
Well, that's a good point then. So I don't have to pick all one of these 16. You could say, let's do number 2, number 5, like a Chinese menu.
Yeah.
And figure that out
Absolutely.
that way. That may make me feel more comfortable. 100%. I'm diversified then.
Yeah.
But the bottom line is I'm avoiding my capital gains tax.
That's right. And you get to choose, and you have control. And I think a lot of owning real estate is about control and about liquidity. And if you have the control over the property and you own it outright, and it's $1 million property in Whittier or whatever, our example, that's one.
It was in Buena Park, Jesse.
Buena Park, sorry.
Yeah, we can't leave this.
Not Sperry Farm. So then you have no control really, because you're stuck just owning that property. And if the rents come in, they come in. If they don't, they don't. And maintaining that. So this allows a little deviation from the control you think you have in owning a property to really diversifying your portfolio and your nest egg for your heirs too. So.
Okay, the next one is commercial real estate properties. So we do a 1031 from the 20-unit building in Buena Park to an office building. This is where Don, our mutual friend Don, would hook you up with a 7-Eleven in Tucson, right?
Yeah, that kind of ties in
CVS.
with the triple net stuff too. A lot of Jack in the Box triple net leases where you invest that money, 1031 exchange it into a commercial property.
Now, I would own, in this scenario, I would own the whole building. So I would sell my 20-unit building but that I own 100%.
Yes.
And I would buy a CVS building in Tucson.
Yes.
And I would own and manage that whole thing myself. Besides the triple, this is comparable, apples to apples.
Yeah, and the appetite for this is narrow for a lot of people because it's a single asset usually, and people are leery of going from something that was familiar, which is apartment and multifamily, into commercial. There's a lot of different rules, the leases, how they draw those up, the tenant themselves, whether it's like a 7-Eleven or a Jack in the Box or CVS, it really depends on the efficacy of that company.
I had a client call me yesterday. He sold his 6 units in Whittier and he wanted to buy. He says, I'm tired of tenants.
Yeah.
I want to deal with a business person.
Yeah.
So, but it is a small window.
Yeah, it is.
But there are people that will. And I just want to show you guys the options that are out there.
Yeah.
And make you familiar with. All right, the next one is a absolute triple net property. Absolute NNN. What is that? Absolute NNN.
Similar to what we were just talking about. So when you have that triple net, you're the owner of the property. The property occupant, the business owner, they actually pay all the expenses to themselves. And so you just are really
pay
the real estate.
Asphalt, electric, plumbing.
Yep.
Anything goes wrong.
Correct. Taxes, all the common area maintenance, all that stuff is on the tenant.
So you get to be like a slumlord then. You just say, I don't know.
Well, it's identifying if you want the hands-off approach and you really don't want to be involved versus if you want to be involved and what that appetite is.
Okay, so say I sell my 20-unit building in Buena Park and I buy a CVS building in Tucson.
Yeah.
And it's triple net. How do I know the person's maintaining the property then? In other words, it's his job to maintain the parking lot.
Yeah.
It's his job to paint the place, make it look nice.
Yeah.
How do I know? That's in the lease?
It's in the lease contracts. Yeah.
But is that one of the negatives then that you have no control over what they do?
That, and it's a single asset. With a lot of the diversification of the DSTs we talked about, a lot of the other opportunity zone stuff, you pick up a diversity, not only multi properties. Sometimes you get. Throughout the United States, so your locations are different too. So you can kind of diversify that way.
I want to interrupt this commercial and just remind everyone once again, make sure you talk to your CPA, your financial advisor. And interesting note, I talked to Jesse years ago and I was sending a client over to him. And before he wanted to get involved, he wanted to talk to the client and he wanted to know the client's assets because he was very intentional of not to steer the client into something that may look good for him.
Yeah.
but it was not good for him.
That's
it
right.
was not in his interest.
That's right.
And so you kind of take on a fiduciary role, like an advocate
Very much so.
for the owner,
Yeah.
saying, yeah, I know you may like this and the returns may be good, but I'm not going to let you get into that.
That's right. And I appreciate your unbiased approach to that because, look, everyone wants to do business and, we're in the business of making money and doing right by our clients. But at the end of the day, doing the right thing and making sure that that's the right thing up front really tells your client that you're doing the right thing. And
You almost talked my client out of it and had to get a restraining order against him, Jesse. It's still in place.
That's right.
All right, the next one is 1031 exchange to energy partnerships.
Yeah. So there's a lot of oil and gas we've talked about a little bit, 1031 exchanging into agricultural properties, but really, that becomes a diversification factor. And again, this whole menu and choice that we have to reinvest, proceeds comes down to that.
So you know someone that can do that. You know a company. I had a company that sold, a client that sold 12 units on Ruoff in Whittier in the 80s, and he did a 1031 tax deferred exchange into an oil well.
Yeah.
And he made a fortune.
Yeah.
Tickled pink.
Very lucrative.
Seems awful risky to me.
It is.
Because your rents on Ruoff, 12 units, it's coming in every month.
Correct.
But I'm assuming you're buying into an existing well then, right? You're not drilling in the desert.
Wildcat drilling. A lot of the oil and gas investments back in the 80s and 90s were more driven toward that initial year write-off, so the intangible drilling costs. So when an oil company drills a well, they have costs associated with that. If they hit oil, that's great, and that begins to pump, and then the pressure goes down over the years. So you're really letting the tax tail wag the investment dog. So you really want that tax write-off and that benefit up front, but you're just hoping that oil well hits and pays off over the long term. So with the fracking and the shale drilling and stuff like that, where now they're going not just straight down, they're going out, that's really provided more certainty in that area. But again, the tax benefits of the intangible drilling costs, that's really been the lucrative part. But I just never want to put someone in an investment just for the tax benefit. I mean, like you said, if we want to use charity as an example, I'd rather give the money to the church or some charity that I want to support rather than buying a poor investment, just to lose money.
I could see a balanced portfolio where you have these other more stable ones and you just for fun, you go, hey, let's throw some money over Texas and
again,
see what happens.
10, 15%, something like that. I mean, right now, the oil and gas business is huge. Current state of affairs with Iran and oil prices being high, I think we'll settle in at $65 to $85 oil. But yeah, I think that the petroleum-based products, natural gas, all the things that we use for, diesel fuel, and there's just a lot of, it's just not just the Texas, sweet crude oil that we make gasoline from. So that's a big business.
I can see an apartment owner sitting down with you.
Yeah.
And then, again, 20-unit apartment building in Buena Park worth $2 million or whatever. And then you then advising and saying, okay, based on what I'm seeing right now with my clients, based on what's going on with Iran, or based on, this is what I think you should do.
Yeah.
20% here, 10% here, and having not only multiple options, but within a decision, multiple options. So not only do you have 16 different things you can do, within the 16, you can pick and choose what you want. It's like a choice on top of choice.
100%. And if you're watching this right now and you're just scratching your head going, this is way too complicated, I do a lot of one-on-one conversations with, just kind of an estate planning conversation, really just looking at the overall picture. A lot of times it doesn't make sense to sell a highly appreciated stock when you can pass it on to the next generation. I mean, we're talking about capital assets, right? And so there's passive income, passive losses, passive gains, capital losses, and it's very confusing. So a lot of times when I just sit down with people and say, okay, let's just start at the beginning. Let me see your tax return. Let's talk through what your liquidity is. Are you a teacher? You have a pension? Were you a pilot and you've got a pension? Or do you have a portfolio that's spitting off, dividends and interest that you're used to? Here we go with the real estate and the rental income. Have you exhausted your 27.5-year schedule for depreciation? There's just a ton that goes into the upfront conversation. And again, if you're watching this and you have questions, please feel free to reach out. I'm happy to give you a consultation and kind of talk through that initially. And then if there's a basis for a working relationship or there's something going forward, then I'm happy to do that.
They can call here. This phone numbers get a hold of you.
Absolutely.
Now, if you meet with Jesse and he advises you not to sell your apartment building, disregard that advice. It's incorrect advice. I just want it for the record here. Okay, next we have private equity placement. What is that, private equity placement?
So the risk and return pendulum I like to talk about when it comes to private placement. So Regulation D, Regulation A, a lot of different investments that are more privatized. They're for sophisticated investors, so you have to be accredited. So you have a certain net worth requirement or income requirement, basically that you can afford to lose money because the risk is a little bit higher. So private placements, they have their place. The private equity firms, they're definitely lucrative investments there. Again, it just depends on if that's what your appetite is, and depending on your sophistication level, depending on how liquid you want to be, they can provide some high returns, but again, with the risk. So,
just a separate question. Right now in this whole list, what do you see apartment owners doing the most, though? And if you had to say, okay, obviously it's paying capital gains tax and then doing a 10th of one exchange, those are probably number one, number two. But what are you seeing trend-wise that's going on right now in this current interest rate and market financial situation?
Well, real estate's kind of stabilized in price appreciation just with interest rates. As interest rates have come up, this property values have kind of leveled off, kind of come down. So a lot of it is relates to, if I sell a property, that's one thing. If it's a life event, if I'm sick, if I pass, there's a lot of reasons to sell real estate that are the positive reasons to do it. But the reinvestment is like the follow-on question. Okay, I made such and such in NVIDIA. I sold that stock at a high price. Great. Now what are you going to do? Sit there with cash? You're going to reinvest. What's the plan to reinvest? So a lot of it is dictated and predicated on how do I replace that cash flow? Because really, people that own rental income, and you can second this, you probably know this better than I do, they have rental real estate for the cash flow. And it's very tax efficient. You got your write-offs, you got your depreciation. So if I have a client, for example, that comes in and says, hey, Jess, I'm going to sell my property. I'm going to have $5 million left over. If that property was generating a 5 or 6% cash on cash rate, I've got to go out to the market, and with capitalization rates, cap rates we call them, being a little bit lower as prices have come up, if I have a fiduciary responsibility to reinvest that capital to recreate that cash flow, sometimes I just look at it and the math just doesn't work out. So I recommend, hey, try to hang on to this property as long as possible. Continue to just collect your rents. Continue to take advantage of your tax, and depreciation. So it just really depends. So there's a lot of work up front, like we've talked about, to make sure that that's the right thing to do.
All right, the next one that we have on the list is residence trust.
Yeah.
What is that?
We alluded to it a little bit earlier. So if you've got a qualified personal residence trust, a QPRT, a lot of this is higher level estate planning. Usually you're trying to avoid estate taxes. If right now the limits are in the $11 to $12 million range to pass on estate tax free. So if you've got an estate that's starting to climb or become higher than that, you can defer the sale of that asset. You give it to the irrevocable trust intended to pass it on to the next generation. And as you take the cash from that trust, then you pay the taxes along the way. So again, if you're watching this, that's a very delicate conversation. That's not for everybody, but it is very highly applicable to when it is.
I'm assuming also part of your strategy would be, I'm 89 years old, I've got health problems, I've got 5 kids.
Yeah.
You would help me put together a portfolio where if I die, that asset then goes to my kids and some sort of a setup.
Yeah.
Because most apartment owners don't think that the kids can handle the management of the property.
True.
And a dirty little secret is a lot of times when people die and the kids promise they're going to keep it, as soon as the funeral's over,
they sell it.
Because they don't want to be involved with it. Because unfortunately, a lot of apartment buildings have bad memories for the kids.
Sure.
Because they had to paint on weekends and pick up trash. I talked to a lady yesterday that said that she was 12 years old and she had to mow the lawn on the building. So I was like, get rid of that thing. They just want the cash to pay off their car loans and stuff. So
and at that point they have that step up in cost basis. So maybe sometimes it does make sense for them to sell it, and pay zero capital gains.
But I would feel better setting up a system where my kids could just have that income from the asset without having to worry about the asset itself.
Yeah.
Mailbox management, you said earlier.
Totally. Yeah, and another noteworthy thing is you can continue to flip these. Like, let's say that the same property owner in Buena Park sells that property, rolls that into a DST. That was the right thing at that time. Let's say they run that for 7-8 years. That sponsor that runs that DST sells that property at a gain, you can continue to roll that and 1031 exchange it again, just as if you owned other real estate. And as people get older, they want less and less to do with this. They just want that mailbox money. And so you can continue to flip these and DST and 1031 exchange into new properties. I've done that several times.
Okay, so I could sell my 20 units in Buena Park, do a DST for 7-8 years, and then do a REIT.
That's right.
And then after a REIT's over, I could then go into oil and gas or something. So I could.
One that we're going to get to right now is probably the 721 up REIT. So this is kind of the hybrid version. Where
Are you skipping the list?
No, but it ties in what you're saying. The 721 allows for like partial liquidity and not as long of a term of hold. So let's say you reinvest the 1031 exchange proceeds into the 721 up REIT. It eventually becomes part of the larger real estate investment trust. But at that like 2 to 3 year point, we can cash in on some liquidity.
So the difference between a REIT and an up REIT is the time frame?
It's a time frame, and it's not just, you can't just reinvest money 1031 exchange into the REIT directly. It's got to be the property that's in the DST. But the REIT company itself has usually a broader, larger mothership kind of REIT. And so the 721 allows you to reinvest that money in a 1031 exchange, avoid that capital gain. But when it upreats, then it allows you to maybe get some of that liquidity. So for clients of mine who they don't really need the money, but they also don't want to pay the tax, but they want the option along the way to maybe take some out, this could be an option. And again, if you're watching and you have questions specifically about that, that's an isolated scenario where we can walk through if that makes sense. And again, to your point, like you can choose from this menu of items and do a 721, do a DST, a little bit of opportunity zone. There's a lot of flexibility. So.
I'm just sitting here thinking as an apartment owner, and I think I have it backwards. I would rather, I think, sit down with you, my wife, and maybe my kids, or at least my kids, and tell you what we want to do, what our goals are, what our worries are, what we're paranoid about, and get that all on the table for you. And then you then say, hey, I hear you. Here's what I recommend. Yep. This one, this one, this one, this one. And then you could customize based on what we want, and what our needs are, and what our financial liquidity is. Yeah. You could customize that for us. That makes the most sense.
Absolutely.
Rather than coming to the list and say, do this, do this, do this.
Well, I don't know the last time you went to the doctor, but if you just walk in and meet a new doctor, hey, my name is Jesse, nice to meet you, doc, and they just start writing prescriptions right away. I mean, for financial advisors in our business, we have a fiduciary responsibility to go through and check those boxes. But unfortunately, a lot of advisors out there are interested in generating their commissions. They're interested in generating as much revenue as they can for themselves before going through that. So if that doctor doesn't sit down and do blood work and ask you what you're already taking, that whole kind of analogy resonates with a lot of people.
I shouldn't come to you and say, I want to do this. I should come to you and say, this is what my needs are.
Yeah.
And I think what I like the most about you, Jesse, is that like in my position as the realtor, I know what title company, what lender, what escrow company is the best for my clients.
Yeah.
And then I think the same thing with you. You know what's going on right now, where money is moving.
That's right.
And why. You mentioned NVIDIA, where money is moving and why. And then that's an important factor in my decision because I'm typically not in this market. You live in this market. So
every day.
I'm glad you came today.
Yeah, absolutely. Thank you for having me.
All right. The next one on the list is deferred sales trust. Deferred sales trust. What is that?
So, in the general sense of selling an asset, putting it into a trust and deferring the paying of those capital gains until a later point, kind of ties into the opportunity zone idea, the qualified personal residence trust idea, where you want to dispose of the asset. Let's say right now the market is really high for real estate and you want to say, hey, I don't want this property to go from $5 million down to $3.5 million. And now I should have just sold it at $5 million and paid the taxes, right? So a lot of people, they want to opportunize that time frame at that high price and sell that asset and then defer that gain until later. And so there's several ways to do that.
Okay.
Speaking to that.
And then staggered sale. What would that be?
Yeah, I mean, that's kind of like to your point about like deferring and seller carryback. Usually in the capital asset area, when you stagger sale, and again, this is a tax question, so really refer to your CPAs for this because we're not tax professionals. But yeah, you can defer that sale and the paying of those taxes in that staggered approach.
So instead of a typical monthly payment, which was the seller carryback, the third one, we would sell the building and then we'd pay maybe a third off in 5 years, another third off in 5 years. So it would be a sale, but it would be the distribution would be staggered.
Correct.
Again, to not avoid, but to kick the can down the road on the tax deferred exchange.
Yeah. A lot of things I like to mention in this area is when you have high capital gains, so it's not just paying the taxes, right? So there's like the depreciation recapture at a 25% rate. There's also the effect on Social Security taxation and Medicare premiums that can go up. So you sell a property and all of a sudden you have inadvertently 3, 4, or 5 other things that are affected by it, and you go, whoa, and your CPA is like, hey, you didn't approach me up front. Your financial advisor didn't coordinate and make a plan up front to demonstrate all of the effects and all the ramifications and the ripple effect of selling this property. So looking at that and trying to avoid those things by 1031 exchanging, by DST, the things we've talked about, it really eliminates the frustration of increased Medicare premiums, increased Social Security taxation. There's a lot of other factors that people don't really think about. And those are the types of things, to your point, when people come see me initially, before they make that decision, I like to walk through all the details and make sure they understand all the ramifications of those transactions.
Before we go to the next one, what are some of the biggest mistakes you've seen people make in this scenario? So I got my 20-unit building in Buena Park. I sell it for $2 million. What, aside from being stuck with capital gains tax, what kind of mistakes do you see people making? You go, I wish they would have talked to me.
Yeah, really giving up that steady cash flow. So, for example, if you've got $1 million property and it's a fourplex that's spitting off, $10,000 a month, $1 million has to be reinvested to make a 10% cap rate in my example, right? So 10% per year cash flow. I've seen them sell that, and then they lose half their income that they were used to getting, and there was no consideration about the reinvestment. So I think that's the number one thing.
They focus too much on avoiding capital gains tax, not on cash flow.
Correct. And again, like we talked about, people that own rental real estate, they own it for cash flow. I mean, that's why you do that.
What products right now have a bad reputation, or is there anything on this list that you go, Jim, I've seen car accidents with this particular investment vehicle?
Yeah.
Anything?
Not particularly. I don't want to call out any names or anything, but there are some real estate sponsors and some investments that, they get a little juicier on the debt they take on. So when things go south in real estate and you have a lot of leverage, then that can isolate that, and pretty much diminish your equity real quick. And, just kind of circling back to COVID, there was a lot of real estate investments in, let's say, the hotel industry, and people loved hotels because, hey, they paid cash flow. They're really short duration leases, one night at a time. And, travel stopped completely, go back to March of 2020.
Right.
They can't go back in time and get those unrented hotel nights back. It was a real good investment up front. So I think putting too much money in one investment has been a bad thing. And again, outside forces, so really diversification, I think, eliminates a lot of that.
Okay, we talked about tax advantage rural real estate,
Yep.
and then we talked about 721 uprate.
Yeah, on that rural real estate. So we talked about that a little bit. I've got a doctor friend that owned a 150-acre parcel in West Austin, and he was able to get an agricultural exemption. He had a house on 1 acre of it, but because he ran livestock, he was able to access some property tax reductions. And so, again, not for everybody, but there are tax benefits on the rural side, and it kind of ties in with the opportunity zone, how they're gentrifying the downtown area. There's also conservation easements and rural investments that you can use to eliminate future estate taxes and capital gains taxes.
So he only paid property taxes on his house.
On the 1 acre.
On the 1 acre,
right.
And then everything else is agriculture.
Correct.
But he's living on it?
Yeah. As long as you run a certain amount of cattle or whatever the agriculture means are. To just touch on the conservation easement a little bit, a lot of times you can invest in conservation easements, get a really large tax write-off up front. I don't do these, by the way, in interest of full disclosure, but basically the government says as long as you forever promise that this easement is there for not building on it, then you can take an immense amount of capital gains tax loss in that first year, sometimes in the 4, 5, 6 range of times the investment. So you invest $100,000 in a conservation easement, you can actually multiply that by, let's say, 4 to 5 times, take that $400,000 or $500,000 loss on the tax return for that current year. So there's other investments out there, to your point, of not just reinvesting in the 1031 exchange environment for real estate, but you take the cash, expose yourself to the capital gain potentially, take some liquidity on the side, but there's other investments we can use to dumb down that tax bill for that initial year.
Which one on the list right now is the hottest, in your opinion? Where do you see the most traffic, aside from the 1031 exchange into another apartment building, capital left
Yeah.
house? Which one do you see is your clients going the most?
Predominantly in a securities business that I'm involved with, the DST. It's hands
Delaware
down.
Statutory
Yeah.
Trust. Why is it called Delaware Statutory Trust?
It's a trust that's created
In Delaware.
that owns the property. So the real estate sponsor goes out, buys the property, puts it in the trust, and so there's some protection there. So in real estate, you guys understand the non-recourse loan. So if you have a rental piece of real estate and there's a loan on it, they can't come back on the investors. So the investors in the DST, they're not liable for a lot of the general liability that the DST owns, but they're investors in shares of the DST. So they own the property eventually based on that.
So I agree with you. I've had a lot of clients. It's actually political. They want to get their money out of a blue state.
Yeah.
They typically went to court and the judge sided with the tenant.
Yeah.
The rental agreement says X. The judge says, I don't care about X.
Yeah.
I'm going with the tenant.
And
they want to move their money.
Tenant-driven California.
They want to move their money to a red state.
Yeah.
Because better assets. So there's
a lot of opportunity.
That's been really popular.
Think about Austin, think about Nashville, think about parts of the country where they are growing. People are moving out of California, and that growth and the businesses that are positioning themselves there for employment opportunities. Florida, there's just a ton of opportunity.
So Delaware Statutory Trust, I own 20 units in Buena Park for $2 million.
Yep.
I sell that.
Yeah.
I pay off my existing loan of $100,000. I take that money, and then you would help me find a partnership or an entity that owns a 200-unit apartment complex in Memphis, Tennessee.
Yep.
And I own $2 million or $1,900,000 worth of that
of those
200
shares
unit
of the DST. Yeah.
DST. Now, I typically would hold that, so I can't control when it's sold,
Correct.
when it sells.
Correct.
So I have to ride it with the other investors.
Yes.
And I feel that's kind of a little bit of downside where they're completely in control of the 20 units. Everything that happens, they're in control. Now they're suddenly not in control.
Right.
It's some other manager that's going to. Now, ideally, we match, like you said earlier, the income.
Right.
I'm making $20,000 a month from those units net, and then now I want you to try to match that $20,000 a month in income, mailbox management, but I lose control.
You lose control, and that's a major factor, and we talked about this earlier, but it's usually an upgrade in the asset. If you're going from a apartment complex in Buena Park that was built, in 1978, you're getting a Class A apartment complex that was built in 2019 that, is only 4 or 5 years old. So the maintenance, you're getting a total upgrade along with the diversification of just a much larger property.
I'll tell my clients, look, you don't mind buying, Apple stock. You don't control them.
Yeah.
You don't know what they're going to do. You have no say in what Apple's going to do, but you have no problem with that.
Yeah, but it's also liquid. So liquidity becomes a huge factor.
So how liquid is my $2 million in the Tennessee 200-unit complex?
Zero
liquid.
Zero liquidity.
So
until,
I can't sell that until they sell.
Correct.
But I'm getting regular income.
Absolutely. Yeah, the REIT sponsor really controls the sale of that asset, and that's the huge point, a sticking point for people that do not like to do this, because they say, hey, I want to maintain control of my property. I know the tenants. I've had them for years. I'm comfortable with the maintenance. That's the reason they don't do this.
My client base loves control.
Yeah.
That's why they don't work for someone.
Yeah.
They like to be in control. And when you say, hey, you're out of control. But when you're 85 years old, control is less attractive. And if you could take that asset, put it in a DST, and as long as you're alive, the income comes to you.
Right.
But then when you die, that income is divided by your 5 kids every month. They get a monthly check every 5 months. They have nothing to do with anything.
And meanwhile, they receive that step up in cost basis. We don't forget that once that's sold, then the kids pay zero capital gains taxes.
And between me and you off the record, is there some way to sell my $2 million in the DST?
No.
There's no one that can buy that from me? Or I can't sell? We're America. I should be able to sell it. So that's the downside, is that you have no control and you're stuck there for 7-8 years. Now, is there a rule of thumb of how long DSTs last? Do they typically 7-8 years?
Yeah, 10 is on the outskirts usually, because there's 10-year.
10 at the longest.
On the longest,
Okay.
There's usually 10-year interest-only financing that they'll use for any leverage that's on the portfolio, and again, that can be from 0 usually up to 50 is kind of the comfort range. Just that 10-year hold period is kind of the bogey.
So if I sell my 20-unit building, give it to you, you buy a DST for me, I should count on that money being tied up for about 10 years. Now, after the 10 years, then I die. my kids could then cash that out with a stepped-up basis?
They can cash it out with step-up basis when the REIT sponsor decides to sell that
Right.
property. Yeah.
Then that way they could get all that money without paying capital gains taxes because of the stepped-up
That's
basis
right.
because I passed away.
Correct. Yep, absolutely. So it's a genius idea, really, whoever created the history of this, because you gain access to property you otherwise probably couldn't afford, while yes, losing a little control, but upgrading your asset and diversifying, as well as reproducing that cash flow. So
now, are there a couple?
Again, just to interrupt
Yeah.
you, sorry, Jim. The timeline also is really indicative of the market conditions. So I've had REIT sponsors sell out at the 3, 4, 5 year mark because hey, this asset just really produced and it made a bunch of money in growth. Let's get rid of it. Let's give the people their money back plus their growth, keep the cash flow along the way, let them reinvest. Sometimes the market conditions are not,
And you would introduce me to a couple of managers that have good reputation, good track record, good
record is
reputation,
huge.
well bonded,
Yes.
well financed,
Yes.
plenty of equity, not over leveraged. Because that's the downside. I remember in the '90s, a lot of these companies went under because they were over leveraged.
Absolutely.
They just couldn't handle a debt load.
Yeah, I mean, the subprime debacle of '08. I mean, everyone that had a $1 million mortgage on a $1.1 million house, hoping it would just keep going up to 1.2 and 1.3. When things reversed, then here you were stuck holding a big mortgage with property that wasn't worth as much as you owe it on it.
What are your hobbies, Jesse?
Oh, I enjoy golfing. I play guitar. I have 2 boys. Love spending time with them, and I have a beautiful wife. Been married for 24 years, so.
You married a pastor's daughter.
I did.
This missionary kid is impressed.
Right. And she's the middle one too.
What books have you read recently, or what books did you read as a kid or high school or college that moved you, that to this day you go, my life has changed because of that book?
I think the Bible.
Good answer. Good answer, Jesse.
But yeah, I read a ton. I'm not a big book reader, but I read a ton of research and articles and stuff like that. So yeah.
So you're up to date on what's going on.
Yeah, I used to, when I was first started in the business, Wall Street Journal had a little column in the center, and one was the U.S. news, one was the international stuff. And so I always kind of read through those bullet points on a daily basis, cutting my teeth in the industry. So yeah.
One more time, just give me a disclosure about what you can't do, what you can't say, and FINRA and the whole thing.
Yeah, so the regulatory bodies that we are governed by are, the SEC, ultimately FINRA. So when we're affiliated, just a little bit of background. So when you do what I do, you can usually do that in a few different environments. Like you could work for a bank, you could work for a broker dealer, you could work for a wirehouse like Merrill Lynch, Morgan Stanley. So I decided to set up my own company called Coastal Wealth Management. I'm affiliated with a broker dealer called Independent Financial Group out of San Diego. And so they're really my access. I'm their client. So I access the floors of the exchanges. They provide compliance, oversight, regulatory stuff. So that's my affiliation with the broker dealer. So
Great.
Yeah.
Well, thank you for coming. I'm going to have Richard, our director here, is going to take this list and put it on the screen so you guys can see it. And the main thing really is it's a lot of information here. We just do a truckload of information, a fire hose of information here. But just to get you to open your mind about the different options that are available, you're not just stuck in your property forever. You're not stuck with a 1031 exchange to another building. You're not stuck with paying capital gains tax. There's a lot of options that are available. I don't know half this stuff. I couldn't understand most of what Jesse said today, but Jesse can guide you through this process. I encourage you to reach out to him, answer questions. I'd just grab a cup of coffee, say, hey, meet us at a Starbucks, and interview me.
Absolutely.
And tell me what you think. And based on my answers, then you could design a custom program for me.
Absolutely.
And put me in a good spot, and you take care of my clients for
Absolutely.
me. So, Jesse, thanks for coming in today.
Thanks, Jim. Appreciate you having me.
Thank you. Thanks for watching, and see you next month at the Joseph Apartments Talk Show.